In its quarterly earnings report released on February 1st, Alphabet, Google's parent company, announced a stock split of 20 for 1. Since going public in 2004, this is only the stock's second split. If Alphabet issued 19 additional shares for every share held, the stock price would drop from $2,700 to less than $150 at today's closing price. The news on February 2 caused a rise in share price of almost 8% to just under $3,000. Stocks of Apple and Tesla, which split 4 and 5 times, respectively, on the same day in August 2020, pale in comparison to the 20 for 1 split. Nvidia, another widely held tech company, will split 4 for 1 in July of 2021. Is a stock split for Tesla imminent? Stay tuned for additional information. In the case of Alphabet, a stock split would cut the price of a share to 1/20th of its original price, making it more affordable for individual investors. Since the start of the COVID-19 epidemic, Wall Street has experienced a massive influx of retail traders. Since March 2020, low interest rates and growing demand for tech stocks like Alphabet, Apple, Tesla, and Nvidia have driven up their prices. Alphabet stock has seen a price increase of more than 100%. Alphabet's massive stock split ratio is unusual but not unprecedented. In 1957, Getty Oil Company's equity split 20 to 1. In 2018, the newly merged bank split 20 for 1, and in June of 2021, the ad tech company Trade Desk divided 10 for 1. The eccentric founder and CEO of Tesla, Elon Musk, made the remark last summer that the stock was too expensive at roughly $1,300, saying that more people should be able to acquire the darling's shares. After that, shares were split 5 ways. 15 months later, Tesla stock is nearing a comparable level following a remarkable increase this year, stoking suspicion that Musk may announce another share division to appeal to individual investors, a rumor that was sparked earlier this month by short seller Gordon Johnson. On August 11, 2020, Tesla announced that it would be splitting its shares of equity 5 for 1. Twitter user Sawyer Merritt reported that the price of a Tesla was $1,373. After the split, prices jumped back over $1,000 to $1,024. It's likely that Tesla's leadership will start thinking about a possible second separation. If Musk follows through on his plan to sell 10% of his shares, which would make him the world's richest person for tax purposes, then we should see a correction in the market cap as we approach the same $1,300 level as predicted by Neil McNeil. McNeil, whose 30-stock post-split index has returned 12.5% annually since 1996, thinks Tesla is overvalued despite having woken up the world to the possibilities of electric cars. However, McNeil notes that Tesla is absent due to the fact that the company's current valuation makes it worth more than all other automakers put together. Almost 400. When compared to rivals, its price-to-earnings ratio is 50 times higher. To reach that kind of worth, the company would need to be operational and profitable for at least 20 to 30 years. McNeil cautions investors to think carefully about these factors before buying Tesla shares out of irrational enthusiasm. To keep its current $1.2 trillion valuation, Tesla needs to sell 31 million cars by 2031, New Construct's CEO David Traynor said last week, adding to the Tesla bear party. 8 times less than its present price, Tesla is only worth $150. Traynor said his goal was diametrically opposed to Jefferies' new $3,000 estimate. However, Exile Capital CEO and ETF investor David Bars disagrees. He argues that experts are making an error by comparing upstarts like Tesla to established players like Ford and GM using outdated measures. Tesla's intangibles, such as its brand patents and goodwill, are enormous if you use a different valuation process and don't consider them into any of the price estimates. According to Bars, Tesla is really just a front for a technology corporation, and the data it collects from its vehicles in order to power its autonomous driving software has enormous potential worth. Applications for this data in the future may include AI, software services, and many others. It appears that the market is misjudging Tesla. Since Musk wants Tesla to be an investment opportunity for everyone, he will likely welcome the prospect of a stock split. However, increasing the number of shares outstanding might also increase executive salary. Investors may regard the shares as more attractive after the split because of the lower price. This is only a theory, not a fact. Johnson of GLG Capital, meanwhile, argues that the idea of purchasing shares at a discount is used to attract investors. Given the positive impact the 2017 split had on Tesla's stock price, a repeat is likely. And since the split last year, that's all Tesla seems to care about. While Tesla stock dropped this winter, it has now recovered to rise by about 7%. For the year, pick a percentage. Yes, now I see it. Gary Black, seeking to explain Johnson's comments on Twitter, cited a 20-to-1 divide as the explanation for Johnson's $67 price goal for Tesla. According to Ed Moya, an analyst at Wanda, Tesla's prospects have improved since the company announced sales agreements with auto rental companies Hertz and Uber. He admits that he was mistaken when he said that he would never be able to save $1,000. The success of Tesla has skyrocketed. They've handled the chip scarcity better than their competitors because of their agility and resourcefulness. Even though the value is absurd, the stock's recent performance suggests that investors should buy. Moya predicts that if Tesla performs a new split, the stock price might rise to $2,000. Investors will welcome a split, and the stock price will rise because of their devoted fan base. Investors should exercise caution and keep their eyes peeled in light of all the split rumors. Since the new stock price is lower, market volatility may increase after a stock split. Because of the low entry price, there will be a flood of new investors. The new stock price may be affected by a wide range of circumstances, including the reactions of investors and market speculation. When a stock gets split, it is usually a novice investor who thinks it is a good thing. Unseasoned traders frequently mistake correlation for causation. Book values and dividends rise with a company's performance, hence a stock split is assumed to be inevitable. An unskilled investor may eventually confuse the two terms if exposed to them frequently enough. However, there are always outliers, and Berkshire Hathaway Burkham's share price of several $100,000 per share proves this point. The price of Tesla stock dropped by $70 for the ordinary person and new investors after Musk tweeted in May 2020 that he thought the stock was priced too high. Musk is mysterious. Shareholders and potential investors alike are swayed by Musk's charming approach to nearly every aspect of the company. If the stock is expected to split, investors will likely follow Musk's lead and purchase shares. It's unclear how much higher tsla will go after the upcoming split. For the same returns as before, the price would need to rise by about 30% from where it is now. If Tesla's stock ever splits again, it may be a fantastic buy. Some industry watchers believe that Tesla will maintain its dominant market share despite the emergence of new EV competitors because of its early entry into the market. However, in the next years, the EV powerhouse will face competition not only from existing competitors, but also from new entrants. Imagine if conventional automakers also made electric cars. What would it look like? Without a split, Tesla stock is certain to continue increasing in value by the thousands, if not the tens of thousands, over the next decade or two, making it unaffordable for the average worker to invest in the company. If the business does well, then that's a bad thing. To prevent this from happening, Tesla will need to divide the stock. Having additional shares in circulation is another perk of a stock split. This expands the pool of available shares, which can then be allocated to more workers or investors. It will be fascinating to observe if Tesla continues to split its stock 5-for-1 or if it switches to a different split ratio. Tesla's overconfidence in the value of its stock could be signaled by a 20-to-1 split. A low split could reflect insecurity. I believe Tesla will maintain a 5-to-1 split, which conveys optimism about the company's future. Please leave a comment with your thoughts on the Tesla stock split.